Listen, if you think SPACs are just another easy way to make quick money, wake up, because you're standing on a ticking bomb. These things are probably the riskiest bets out there right now, no sugarcoating. You see tons of hype, flashy headlines promising the next unicorn, but behind that glitter, it's a freaking mess. The problem? SPACs let companies sidestep the usual scrutiny. They don't have to show their full cards up front like any traditional IPO would demand. That should scare the hell out of you, and if it doesn't, it means you're either ignoring the truth or betting with your eyes closed. Here's the brutal reality. SPAC sponsors have undeniable incentives to push deals through quickly. They make their money on the back end, on the merger. That sets up a glaring conflict of interest. They're not looking out for investors, they're looking out for themselves. That fast timeline crushes the deep due diligence you should be demanding. And you? If you're just relying on surface-level info or trusting glossy presentations, you're setting yourself up for disaster. It's like handing your cash to a wild card and hoping for the best. You want to invest smarter? Stop getting seduced by flash and rumors. Dig deeper than anyone else. Challenge every single number, every claim about growth, every word about market potential. Most SPAC targets haven't even earned consistent profits or proven they can survive without sugarcoating. If the company can't clearly explain their business model, run away. If management looks like they're using buzzwords to hide shaky foundations, don't hesitate to pull the ripcord. And here's something almost nobody talks about: market liquidity. Upon merging, SPACs often get dumped by insiders who get shares for free or super cheap. That creates massive sell pressure right after the hype dies down, killing share prices faster than you can blink. So if you just jump in at the peak, hoping to ride the wave, prepare to get crushed. You need to look for insiders' lockup periods and how much stock they actually hold after the deal. If somebody is positioned to exit early and fast, take it as a huge red flag. Most importantly, stop thinking SPACs are just simple bets like regular stocks. They're closer to startups where transparency is low and volatility is insane. Treat them like high-risk ventures and allocate your capital accordingly. Don't pour in your core portfolio money unless you want to gamble with fire. Build mental stop losses ahead of time. Be cold and ruthless when it comes to exiting. The market won't wait for your ego. It will chew you up and spit you out without blinking. If you want real edge, look beyond the noise at how the sponsors operate. Find out who backs the SPAC. Are they seasoned operators with skin in the game or just financial hit and runners? Check their track record on deal success, not just flashy press releases. Align with the few SPACs that have clear mission, solid fundamentals, and honest growth paths. If you don't, you're just feeding into a hype cycle destined to burn most people. Here's the bottom line: SPACs are a financial playground clogged with traps. If you want to survive and crush it, you have to be more ruthless, more skeptical, and far more prepared than anyone else. Don't fall for comfort or shortcuts disguised as opportunity. Demand full transparency or walk away. Treat every SPAC like a startup trying to fool you, and protect your capital like it's your last damn dollar, because in this mad game, it just might be. Subscribe to our YouTube channel and visit the featured link to learn more.